In this video, we're going to talk about safe and risky assets that you can buy that can produce income for you. The first three are conservative, low risk, income producing assets. The trade off, though, is its low volatility, which means you won't earn as much more aggressive and risky assets. It's still a good idea, though, to have a few of these in your portfolio to ensure proper diversification. The last four assets in this list are riskier investments that might require more active management on your part. The earning potential for these investments is high. If you put the time and effort into these assets, you might find yourself with a very nice sum of money to show for it. Here's the list of the 7 best income producing assets that you can invest in to start earning passive income. Asset number 1, certificates of deposit, also known as CDs. A certificate of deposit, or a CD, is a low risk financial investment offered by banks. How they work is simple. You loan the bank money for a set amount of time, known as a term length, and you gain interest on the principal during this time. A typical term is anywhere from 3 months up to 5 years. During this time, you won't be able to withdraw your money without taking a penalty hit, but it's pretty much assured that your money is growing at a fixed rate. The interest rate varies on how long you're willing to invest it for. The longer you loan the money to the bank, the more you can earn. And since CDs are insured by the FDIC up to $250,000, they're incredibly low risk. But there are a few drawbacks. The first drawback is inflation. The average inflation rate in the US over the past 60 years is 3.7%, which stands on the high end for most CD interest rates. This means that you can actually lose money if you keep your money in CDs because of inflation. Another drawback is low aggressiveness. If you're young, that means you can stand to be a lot more aggressive with your investments because you just have much more time to recover from any losses. Your potential for growth is also much higher. This allows you more wiggle room to invest in riskier assets and potentially earn more money. Another drawback is the length of investment. You might not be able to part with your cash for a long time, especially if you have other financial goals in the near future, such as buying a home, a vacation, or a wedding. Buying this asset is a good idea if you want a low risk investment that ensures you a peace of mind. Asset number 2, bonds. Much like CDs, bonds as an asset are like IOUs. Except instead of giving it to a bank, you're lending money to the government or a corporation. And they will work similarly to CDs as well, which means they're extremely stable, guaranteed return, but smaller in the return. If you want to know exactly how much you're going to get back, bonds are a great investment. Asset number 3, real estate investment trusts, otherwise known as REITs. The US Congress established real estate investment trusts, or REITs, in 1960 to give people the opportunity to invest in income producing real estate. REITs are like the mutual funds of real estate. They're a collection of properties operated by a company, otherwise known as a trust, that uses money from investors to buy and develop real estate. They're a fantastic choice if you want to get involved with real estate investing, but don't want to make the commitment of purchasing or financing a property. Like with most blue chip stocks, more on those later, REITs play out in dividends. REITs also focus on a variety of different industries, both domestic and international. You can invest in REITs that build in apartments, business buildings, or even healthcare facilities. As a note, there are some taxable implications for REITs. In all, they're a straightforward way to get involved with real estate without having to eat the upfront cost of buying property. To get started, go to your online broker and purchase a REIT like you would a typical investment. One I would suggest looking at, the Vanguard REIT ETF, stock symbol VNQ. This is a Vanguard ETF fund that tracks a REIT index from MSCI Inc., a noted investment research group. Asset number 4, dividend yielding stocks. Some companies pay out earnings to their shareholders each quarter via dividends. These are known as blue chip stocks and tend to be reliable and able to weather most economic downturns. Many investors like to add a few dividend paying securities via blue chip stocks in their portfolio to ensure that they're receiving earnings consistently throughout the year. And while some like to handpick individual shares to invest in, you can get started by investing in index funds that specialize in high yielding dividends. Here's a few suggestions to take a look at. The Vanguard Dividend Appreciation Fund, stock symbol VDAIX. The Vanguard High Dividend Yield Index Fund, stock symbol VHDYX. The Vanguard Dividend Growth Fund, symbol VDIGX. And the T. Rowe Price Dividend Growth Fund, PRDGX. Asset number 5, property rentals. Renting out properties seems simple enough. Buy a house or apartment building, rent out the rooms to tenants for a nominal fee. The rental checks come in like gangbusters each month while you sip on pina coladas and make passive income. Hell, that does sound really awesome, but it's also a complete oversimplification. In fact, renting out a property is anything but relaxing. That's because you're responsible for all facets of the building you're renting out as the owner. That includes repairs, maintenance, and chasing down tenants who don't pay rent. And God help you if they do miss a rent payment. If that happens, you'll have to find another way to pay your monthly mortgage payment. You can make money from renting out properties, and many do. It's just that doing so can negatively affect your finances in a big way. Luckily, with the rise of services like Airbnb, you can just rent out a spare room in your house and not worry about buying a separate apartment or house specifically to rent out. You simply sign up for the platform and take advantage of short-term rentals. You'll still have to deal with certain pains of property management, but you'll be able to leverage the property you already own, for example, a spare bedroom in your house. Asset number 6, peer-to-peer lending. Also known as crowd lending, peer-to-peer lending allows investors to essentially act like a bank. You loan money to others via peer-to-peer lending platforms such as Lending Club, and they later pay you the money back with interest. Unlike a bank, though, the person seeking the loan doesn't have to deal with financial background checks or incredibly high interest rates due to things like a bad credit history. P2P lending isn't without its risks, though. In fact, relying on someone with crappy credit to pay back a loan might be one of the riskiest financial investments that you can make. But if you're willing to devote yourself more to learning about the platform and use money you don't mind losing, it can be a very fruitful financial investment. Asset number 7, creating your own product. This is one of my favorite ways to make money. It's also a way that you can build an asset instead of buying one. Not only is it low cost, but it's also easily scalable, meaning the sky's the limit for your earning potential. And you don't need engineering or carpentry skills to create your own product either. In fact, you probably use products every day that you could create too. Ebooks, online courses, podcasts, webinars, anything really. These digital information products are perfect ways to earn money without sacrificing overhead. But they do come at a cost. And that cost is your time and your energy. Not only do you actually have to create the product, you also have to make sure that the product will sell. That's all for this video, so if you enjoyed the video, hit the like button, and if you want to know when we upload more videos like this, hit the subscribe button, and also hit the bell notification so you get notified every time we upload. We'll see you in the next one.